Hello, everybody. Welcome to the final CPE session time slot of the day. I'm Danielle Supkis-Cheek. I'm our VP of Strategy and Industry Relations. I'm going to talk today about the use of anomaly detection in traditional audit methodologies. Before I get started my presentation, I'd like to create a shameless plug for the session that is right against me right now. Joe Welsh is working on some of the most innovative stuff that we have working on in MindBridge related to internal controls. So if you can't catch his session because you really do want to be here, please go back and watch his recording, as well as he has a November webinar that kind of this session is going to be his 101, and then next month is going to be the 102 level concept of MindBridge for internal controls and anomaly detection and internal controls. With that said, welcome to Audit Methodology. My background is in audit and consulting and forensics as well. I've been at every size CPA firm out there, including owning my own firm for 5 years and being at the Big Four, G400, and a small 25-person firm as well. At the most recent firm, I led our data analytics and forensics practice, and then was a customer of MindBridge before I got to MindBridge itself. I've been around the standard setting world a little bit. I'm the former technical issues chair for AICPA. I'm now the U.S. representative to the IFAC SMP AG, which is the Small Medium Practitioners Advisory Group, which that isn't a mouthful at all. I sit on the Peak IT Services Task Force. I was a late add after the hosting interpretation came out and when they were exposing the IT services one. And then I also sit on the new IASBA Technology Experts Group as well. So I've been around, and actually I was on the CPA curricular committee for the BAR section as well. So with that, I'm just going to jump right in. We have a polling question launched already. Please ask your questions as you go or put things in the chat. I'll try to do my best to tailor this session to as many people as I can. The first question is really about making sure I tailor this talk to kind of more transformative theory or quick efficiency wins. Based on the staffing shortage that we're all facing right now, I was going to focus more on the quick efficiency win concepts, but I also want to talk about big transformational items, or at least provide resources for transformation items. A quick disclaimer, because I sit on so many advisory boards, everything's my personal opinion. Don't blame everybody else for my personal opinion. So getting into the weeds, we're going to first talk about the concept of ensemble AI in traditional audits. Then getting into what is audit evidence. Rick Reising talked about it this morning on SAS 142 if you're on the US side. And then I'll also talk about the complementary international standards project. Sampling, engagement monitoring for anybody that's going through ISQM. You know, we have like 2 months and 2 weeks or something like that, something crazy short left. SQMS, if you're in the US, you have a little bit more time. We're going to touch on risk assessment. If you want a deep dive on risk assessment, I have another webinar we can reference you to on risk assessment. A little bit about the concepts of processes and how you see processes through anomaly detection, but I'll let Joe be on your recording, watching Joe, be the deep dive there. And a little bit about transparency and ability to rely upon these approaches, especially with the new technology ethics project from IASBA. So getting right into the weeds, the use of ensemble AI in audits. What we're trying to do, and it's different than traditional audit data analytics as a screening test. When you use ensemble AI as a method of testing the entire population, what you're doing is you're layering on so many tests together that you're saying all these different attributes about a particular transaction over the entire population to try to cluster them and figure out what is truly anomalous and different from every other transaction. Traditional audit data analytics usually do 1 or 2 screening tests where you start with the financial statement level and you screen down to try to find out what is interesting or different. When you start the other way and in effect categorize everything of how different everything is from each other, you can start thinking about different transformational approaches to the audit as well as quicker efficiency wins because you have the ability to segment populations in a different way. If you think about a transaction is in a general ledger as a byproduct of the control environment that shapes it. So I'm not talking about a test of controls. I'm talking about the control environment shapes how a transaction exists in a ledger. Hopefully that's a clear distinction. Control environment shapes. I'm not saying we're doing a test of controls. I'm saying the end result of the journal entry shows something about, not the whole thing, but something about that control environment. you can start to see how we can shape the audit. And I'm actually a little bit surprised that we have about an even split between quick efficiency wins and bigger transformational projects. So when we get into audit theory, and when we're trying to find what is different from each other and why is that relevant to the audit, because it's all about relevance to the audit. So if you think about an organization that has a very strong accounts receivable process, so if you're a manufacturing entity and there's even in will call, there's a strong AR process. So in will call, it just moves through AR very quickly, but still runs through AR. The transaction structure of those transactions should actually always pretty much be revenue to AR, AR to cash. If you happen upon a transaction that goes directly from cash to revenue, that does not violate accounting standards or accounting logic, right? That's still a logical explanation of a transaction making business sense from an accounting perspective. Like debits and credits make sense. However, for that entity, that is an indicator that a process has been bypassed. Somehow it didn't go through AR. Maybe there's a manager, maybe there's all these different things, but it didn't hit AR. In a traditional audit approach, how would we catch this? Well, I reckon to say it's actually really hard to catch. On the revenue side, when we're working with the revenue subledger, I don't think most people will catch it. Most of the time, you're not seeing what module it's hitting, if it's in or out of a module. Maybe you catch if it's a manual transaction, if it's a mapping issue, you probably wouldn't catch the matching issue. It wouldn't be in the AR subledger because it never, or the AR testing because it never touched AR in the first place. And then in cash, most people are still focusing on, in the cash position, the more existence concept at year end and a little bit of cutoff. Not to say that everybody's not worrying about all the other pieces of cash, but those are the ones that are worried about the most. And you're usually not looking at what's generating cash. For the organizations that are doing these mass proofs of cash, so that they in effect proof and vouch in effect the entire income statement. So it's not the balance sheet approach, it's validating the entirety of the income statement by looking at the cash inflows and outflows and correcting for cash transfers, correcting for CapEx, correcting for accrual-based concepts to in effect validate that the activity moving through the income statement is realistic as compared to the cash operations. Even in that regard, you're probably still not going to catch it because you're looking at the aggregate number most of the time when people do those tests on the inflows and outflows. So probably in a traditional audit approach, you would never find that one particular entry unless it's just, good luck that you find it. When you start to think about, you can start to see those kinds of risk of bypass and you see all those underlying risks or underlying issues, and you start aggregating those up to the financial statement level rather than starting at the financial statement level and then drilling down and doing screening tests. So how we do this in Ensemble AI is you layer on so many tests that run effectively simultaneously of traditional rules-based, statistical-based, and machine learning to try to see how different every transaction is from each other. And all these different approaches are individually best in class for their different way. But what a lot of people don't realize is that each individual test is good, but it's not as good as adding them together. So the sum becomes more than the whole is more than the sum of the parts. I got that a little backwards at first. And so there's even papers out there that talk about these concepts of the aggregation of tests where you have even poorly designed. So let's just pretend something's poorly designed at the one-off test level. Even a mediocre ensemble will outperform a perfectly designed test. So that means we can have an aggregation of mediocrity, which none of us like because we're perfectionists as accountants. But even still, that will work better than perfectly designed one-off tests because you're only testing for one piece. So why has the audit profession not done this in the past? If this is a good approach, why aren't we doing it already? And the reason is it's hard to do. Nobody has been able to do it very well in the past. A lot of people have tools that are good at one-off pieces, maybe 5, maybe even 10. But to get the true level of how different something is, aggregating up 32 tests, and at our, I think you may have heard Leighton's talk about this, any one of our individual control points that compares every single transaction to every single transaction has to assess 250 quadrillion relationships, like the one I just talked about. in order to make a determination of how different every transaction is from each other. So that's a lot of compute power that's usually not been in the hands of CPAs being able to do it, particularly at the very beginning of an engagement for scoping. So now we have the ability to identify what transactions are different from each other. And then what is anomalous becomes kind of interesting. Most people believe and equate the term anomaly to be something interesting. They equate it to be, ooh, I found something really different and that's really cool. And this is really what's super, super amazing. And this is the big nugget of information that I wanted to find, which is good, that counts. But we classify anomalies into three categories. We have the known knowns, the known unknowns, and the unknown unknowns. The unknown unknowns is those big transformative aha moments that everybody wants to have. And those are good. I'm not going to diminish those values. But what people then kind of misrepresent anomaly detection to be is they find something like, oh, I already knew about that. That was boring. But what that does for you, though, is when you find those boring ones, it's validation and the ability to rely on the approach that you're finding things that are rare and infrequent. So month-end journal entries, a lot of your closing entries, payroll journal entries that get general journaled in and only happen, let's say, 26 times a year, something like that. Those things we know to be rare and infrequent. We already do traditional audit procedures because we know they're rare and infrequent and high risk. So a tool or an approach that is identifying those as more anomalous than everything else is a validation of the tool. And you need to be taking credit for that in your methodologies and your approaches and saying, look, this is proving that the approach works. It's not saying we need to go do extra testing. You can then bifurcate those populations. I really recommend, if you didn't see Jason Bradley's session this morning on the FRC's approach to outliers, that's a great way to assess different outliers that may be coming up and how to stratify samples. So let's say all the payroll transactions come in and what do I do with these? I'm so worried. I don't know what to do with these. I don't want to do more work. Segment those out and say, go see this payroll work papers, those kinds of concepts to make it so that you don't have these scary amounts of results, but then also note that this is proof that our approach is working because we're catching things that we know should be rare and infrequent. The known unknowns are usually what people create preventative controls to mitigate at the organizational level. So stuff about miscodings, the multiple reviews to make sure something doesn't get miscoded. So those are kind of things that we know to happen, but we don't know when they actually happen. So we know we have a problem with miscodings potentially, but we don't know when there's a particular miscoding. And then the unknown unknowns, we just have no idea. And we have no real way to identify those kinds of things. You can think of those as almost the management overrides, bypassing controls risk. And most organizations do not have a specific control activity associated with management bypass. So to the extent you want to, leverage the tool in order to have some entity level control work, there's that. But also, we've started to see more commercial enterprises start to look into this component of it. And that's what Joe's session is going to be about. Now, getting into, let's progress into audit theory. One of the things that a lot of people are hesitant on is where do I go next in the audit approach? So the progression of audit, in my mind, is most people take JECAT as on steroids as a first use case. It's kind of the obvious use case. It's really kind of straightforward in comparison to some of the other use cases. We did just put out a journal entry CAT testing or JET testing, whichever is the acronym you prefer, the kind of little handbook for how to approach it. You'll be able to download these slides and actually click on that link. You can also find it on our website. So the different scoping options and sampling options in order to do your JECAT testing. That's good. There's nothing wrong with doing JECAT tests on steroids, but I think what you're here today is to learn about what's next. If I saw y'all virtually, I'm sure there's some shaking heads. Yes. So here's where we get into. To me, the next progression of theory ends up being sampling and having more efficient sampling approaches within the theory of audit. Now, I'm going to talk about some transformative approaches, but I'm going to just talk about some project management approaches. And then we're going to break into kind of two different buckets of more engagement efficiency wins, as well as like quick efficiency wins versus large scale transformative engagements. And if anybody's trying to keep up with me on the slides live, I do jump around in my slides. So hopefully I won't stress y'all out too much. So the entire approach of sampling theory efficiency is based on the concept of audit evidence. So Rick Reisig talked about it this morning and kind of talked about SAS 142. One of the important parts in SAS 142 is that an ADA scoring model was explicitly written into the standard. It's in Exhibit A. If you want to read this, I'm not going to read this to everybody, but it's complete population testing with multiple tests concept. That is written in to the standard in audit evidence. It's there. So no longer is there a large, very public push of technologies impermissible in certain standards. In the ISA version, there's nothing that there's no, at least in the current draft, there's nothing like this written into it, but they're actually trying to broaden and be even more technology agnostic. So the piece that you should work on for audit evidence, in my opinion, that leads to sampling innovation, so it's all based on audit evidence, is that there's a big push right now for the completeness, reliability, and all these different things of audit evidence, right? When you go in and already validate the completeness of the general ledger in order to do your JECAT, you've already done the work to make that data reliable for everything else. To be able to use, you still have to audit it and vouch things, but you have a sample or a population, not the sample. You have the population that is ripe for being sampled without putting more things onto the PBC list. So the approach is, once you already have the data in the system, using the approaches of, okay, we already validated that's complete. Now we start building on what else can we do. And it's not just about the major sampling innovations that are going on. It's about order of operations. It's even simpler than major transformative theory. So let's say most people test in their AR section and their revenue cutoff, and like 2 staff are doing the AR section and the other one's doing the revenue. You probably have good staff. Probably not enough of them, but you have good staff. And the person doing revenue is probably going to catch the same key item that somebody doing AR is going to catch. You're going to the revenue person's going to probably catch it because it's near year end. It's a large amount. It's going to be a cutoff risk and just a key item in general. The person on the AR side is probably going to catch it because it is a large outstanding balance, because the revenue side was so close to year end that the cash hasn't come in yet. They're probably working on different reference IDs. The AR person is probably working on the invoice transaction ID or something like that. And the revenue person is probably doing some kind of sales order or some kind of other transactional kind of something tied to sales. They'll both put it on the PBC list. They both won't realize that they put the same underlying transaction on the PBC list, each grabbing one side of that transaction. It hasn't been linked together for them. What ends up happening, as you probably know, the controller gets the list. They say, I gave it to the other person, or I already gave it to you as the team, not knowing which person they actually gave it to. Second person doesn't get it, says, wait, I asked for it. I didn't get it either. Like, what are you talking about? I didn't get it. I didn't get it. You have this back and forth. So not only do you have the timeline risk of the back and forth on the PBC, but you also have the inefficiency with the client, and very visible to the client, and maybe a little bit of client frustration, probably not anything insurmountable, but once everybody realizes. So now, instead of dealing with that issue, what if we're starting to sample from the entirety of the ledger, scaled down to the different populations, subpopulations we want to test that match to our different either PBCs, knowledge coach, all the other different third-party methodologies out there. And we get to see what tasks are already open by others that are selecting. So let's say we have a sample size calculator comes back and says, I need to have 25 in this particular subpopulation. I have the saved filter for that particular criteria of that subpopulation in my data table, and I see that 3 are already selected through other means. Can I take credit for those 3? Now, you probably each need to assess that based on what's going on, but now I only incrementally have 22 because of the order of operations. So if you do your JECAT first, at the very early stages of engagement, most people do JECAT at the end as a check the box, make sure I got it done so I don't get in trouble with the standards. Now I'm using it to, in effect, scrape out all the really high risk transactions potentially and see what, okay, almost a residual risk concept of what's left over in each of my subpopulations and not have to do duplicate testing all over the place. And then the efficiency of different tests in different areas. Now, Is that permissible in the standards? The short answer is yes. The standards pretty much now say, or are as drafted, say that you can do one thing and have it count for multiple areas. And that helps you on all the different concepts of corroborating evidence. And you save the time on all the the tracing that you had to deal with to validate that that subpopulation was matching to the general ledger or the trial balance, however you were going to trace that. So you save some time and efficiency there. Now, getting into more aggressive sampling theory, and actually aggressive is probably a misnomer. It's not actually that aggressive. We recently did put out a sampling guide and a big shout out and thank you to Cherry Beckert, who helped us with that. They came up with a 6-step process to reducing your sampling theory. I don't want to overly go into this, especially since people wanted to have a little bit more transformative nature conversations. And we have a specific webinar just on this topic that you can find on demand on the website, as well as the sampling guide that you can download. The short of how this approach works is that, in effect, solve for the maximum allowable risk that you're able to accept in a population because you're able to bifurcate in a different way. And so that will then allow you to use your traditional sample size calculator. Here we go. Sample size calculator to get a lower sample size because you have a more acceptable risk threshold. So this particular example was, I believe there's a revenue related sample selection, and probably I would guess this is a PCAOB regulated engagement, a large or a decent public company sized engagement for that kind of sample size. But as you may or may not know, the PCAOB, I think about a year ago, last November or so, was put out comments that based on the results of that year's inspections, a real big focus on justification of samples and making sure that the sampling theory was making sense and that things were being picked appropriately. So this would help be a robust approach for how samples were selected, particularly for your public engagements. Okay, moving on. The next piece that I think people really want to talk about is other quick engagement efficiencies, going on the progression of transformative theory, that what we can do within, okay, we already have the completeness report that assesses that the data is reliable and complete, still has to be tested. So reliable in the sense of its completeness, and it vouches out. I don't know if your staff have ever had to do that in one of the more not automated ways. I teach it in university. It usually takes me 3 lectures just to teach them how to do it in a more manual software rather than just, export the report. So once the data is already there, where you can start getting other quick engagement efficiency wins. We created an entire video series. Michael B. did these, and he will be on our Ask Mindbridge Anything session for any more technical questions. Leaning in heavily to the concept of cooperating audit evidence. I'd be surprised if a lot of people aren't paying attention to SAS 142 for audit evidence, but I don't think anybody's doing like a lot of methodology updates. I think it's just going to be a round of what people are kind of focused on as the organizations come online with SAS 142. So a lot of times your engagement staff take a quick response from a different controller or something like that, and don't really do anything to validate something that's like, oh, that was rare and infrequent and only happened once. Let's say it's below some nominal threshold. They want to waive on it at the work paper level rather than having to extrapolate it or do something more. Usually you'll catch that at a strong senior level, maybe an early manager will catch that they didn't do enough work. Even your really, really top-notch staff that say, look, I need a report from the system to make sure what you're saying is accurate, then still has to spend the time tracing. So rather than all that time tracing or that back and forth on review notes, going through and teaching people to use the data to do quick cooperating evidence concepts, do a quick search, do a quick visualization, do a quick, and this is not just in one particular tool or in anomaly detection. This is kind of a holistic training concept of what can you do very quickly where the data already is to be able to corroborate what they said. If you can then corroborate very quickly and find out, let's say we look at the parameters of what they said is rare and infrequent, and then all of a sudden that really is rare and infrequent, it doesn't happen anything else, then great. Then we can then, waive on it at the nominal threshold. If it's something that maybe happened a couple times, maybe it is rare and frequent, but it's not rare and infrequent enough to be able to pass on it. Can we start to extrapolate that known error, not against the entire population of the, let's pretend we're working on revenue, just because I always talk about revenue. So instead of extrapolating it over the entire population of all revenue, which get to be a big number very quickly, and people usually have to add on additional tests to, for the lack of a better word, wash out the impact of that transaction and that error, can we extrapolate over the known population that this is relevant to? Now, that's going to be a question for everybody. That's probably a question for each methodology provider, or that's a question for each engagement team, because it may differ depending on the data sets. But is that an option that you can start creating engagement efficiency wins? Because now you don't have to test extra things. You're probably actually more precise in the estimate of the error. And you can start to figure out, like in a really specific way, yes, this really is the precision of the particular issue I'm dealing with. And then you can make your auditor judgment deciding on what you can and can't do. Planning is another area. Too many times I see, same as last year's style concepts, roll forward the engagement, roll forward another engagement related to a similar industry, and certain areas get over tested. I think if you heard Jason Bradley's session this morning, pretty much alluded to, if not outright said it, that if you over test in an area, that's actually taking away time from time you could be spending doing other areas that may be not getting the attention they deserve, maybe are more important. So, to the extent that we all have commercial considerations that we have to deal with, until the point where auditors are no longer self-regulated and it's a government entity kind of concept, we're going to have commercial considerations. So if we waste all our budget over testing in areas that are not really relevant to this particular engagement, but it was particular to the other engagement, then we waste time on things that don't matter. So it's a concept of focusing on what matters. I saw a question come in, I think to Rick Reisig, about the concept of not knowing what procedures to drop and kind of this belt and suspenders approach of it's only been additive. Yes, things have been additive because people are afraid of when a regulator, like, what do we do? Do we leave the tried and true way or not? But I'm saying there's a lot of place for efficiency in the tried and true traditional approaches that have innovation baked into them, just based on project management methodology concepts and order of operations. And then you can start building on those big transformative wins. And then a lot of stuff around understanding the entity that we can do to assess and help for kind of getting into a client meeting at those early stages. Many of us will probably still have methodologies that are based on, okay, how was your year? It was good, great. That means our expectation is plus or minus 10% and 50% TE or 75%, whatever may be the case, or PM. I still use TE still. And that doesn't really help you on the precision of asking really strong questions that are really precise, that get you to core issues that may or may not exist, but it keeps everybody more focused. And you don't annoy clients with concepts that are not necessarily always relevant. So if you do that plus or minus 10% concept and they had a really good year, and you ask a question about the increase in revenue, and then you ask the increase of COGS, and they're like, well, we had a really good year. By the time you get to the disaggregated revenue analytic at some point, that's probably when you're starting to notice the distortion in particular margins on product goods. So you're getting these early stage conversations that are so generic that you could probably almost have the same conversation with every single customer and your audit approach would not change. That's problematic because that means the audit is not being tailored enough to the risk specific in that data set or that client. So if you can look, and because you have the data early on, and do these assessments earlier by saying, oh, I know I have a problem in November with this one particular issue, let me send that question. So what we recommend is using our annotations feature to be able to put those PDC questions in there. And if you heard our speaker this morning on asynchronous management, in effect, a lot of the world really is going asynchronous. Can you send some of those questions over ahead of time in email or something like that to the extent you're comfortable with it? There's a space to be able to put customer or client comments in it, and then have them respond back, and then you archive that as your work paper documentation. And so now you've had less work without having to, how do I put this? You've done less work, but you've actually done more work behind the scenes. You're taking credit for doing a full amount of analysis behind the scenes, but you're taking the credit for interpreting it very precisely and then modifying the nature, timing, and extent of procedures to customize and tailor to that particular engagement. So now I think I should switch over to larger transformational concepts just because of where we are on time. And I haven't seen any questions come in yet. Oh, I do see one. Okay. That is a very good question. So the question is, do we gather peer review results from our clients to understand the nature of conversations, comments, findings, matters that resulted? I'm nervous about peer review and not understanding this approach. Extremely fair comment. I actually owe an email to a couple people at peer review board to try to be more proactive in educating them. I am aware that there are some peer reviewers out there that are a little bit more, let's call it old school in their approaches. I typically, when a customer of ours is going through either a peer review or an inspection, I usually get a heads up if the client wants to notify their CSM. And I have reviewed a couple clients' responses on engagements that were selected using MindBridge. Just to be ready for, if something comes up that needs a little bit more explanation. And I'm happy to always get on a call with anybody's peer reviewer or inspector to the extent that that peer reviewer or inspector finds it to be appropriate to help explain the approach and the reliance, especially on the transparency. So I know I'm kind of jumping around on this, but we've done a lot of work based on how to rely upon us and how we are reliable. And that we're not overtaking the auditor judgment and in effect helping surface things to the top that the auditor should be paying attention to the extent that their methodologies align with that approach. That gets us into the conversation of, and now I'm really off topic, but I'm going to go there because I think y'all are going to want to hear this on document retention. So I get a lot of questions to my group or to me on document retention of what do we keep in MindBridge and what is MindBridge? Is it part of our engagement file? Is it an obtain but don't retain concept? And what do we actually need to keep in the file? So I'd say what most firms that I've talked to and assisted with treat MindBridge as an obtain but do not retain concept. It's not considered part of the engagement file, the MindBridge system in itself. It's only the stuff that is exported from MindBridge and then archived in the work paper solution. So that disconnect is actually a little bit nice because it means that you don't have an easily navigable tool for whatever regulator, inspector, peer review, or even litigation, due diligence, expert witness type person will go into the tool and figure out what you should have known about in hindsight, with hindsight being always 2020. With that said, there's certain firms that are creating procedures about when they want to dump the MindBridge data. They usually like to have it so they can roll forward. And then once the roll forward is there, they discard the past years. I'd say it's fairly split on firms on if they like to keep the actual general ledger export. I'd say about 2/3 of firms that I talk to do not actually keep the general ledger export at all in the engagement work papers. And 1/3 probably solidly keep it and are very strong in their convictions that they need to keep it for sure. I have no opinion on which way is the right way. I think both have their merits. The piece that I say almost everybody has some concept of is in the centralized methodology function, some kind of memo that talks about the reliability of MindBridge, and then within the work paper, some kind of note that talks about the use of MindBridge on the tool. We created a Rely on MindBridge that was compliant with the new IASBA technology experts. Technology reliance on an output project that has these, I think it was 5 criteria to assess. So we already did that work paper. And I actually have, I think, a slide on that. So I'll just jump to that one. So here are the criteria. So we've already assessed that and created a work paper. And we also did it for the ISQM vendor assessment. So that ISQM vendor assessment, for anybody that's going through ISQM, we've already pretty much create a work paper so that you can use that to help guide you through the assessment of us to rely upon our output. And then I'd say most people keep the completeness report from MindBridge in order to show the reliability of the audit evidence. So I've gone a random deep dive, but since I said ISQM, and that was actually going to be my next topic, I actually kind of wove these together except for my random deep dive. So engagement monitoring. Um, One of the things that's going to be interesting for ISQM and the US standard, the SQMS, that is just come out a little while ago. So ISQM, if you don't know, is December 15th of this year. Got to be ready to go. And SQMS, you have a few years out still. What we have done, and just so you know, this is still a very rough concept, is we are starting to try to look for what are anomalous engagements for y'all. So we have the ability to run a report with your approval, of course, that can show which engagements you have that and what risk score profiles that you have within each of your engagements by the different line items on the financial statement. I think most people are going to care most about revenue and cash. That seems to be what a lot of things come down to on risk profiles. But you can start to think, how can you not just transform one audit engagement approach, but your entire monitoring function to see what kind of risk profiles do you have within engagements, and how does that, respond to not just your client acceptance, but more of that ongoing monitoring concept, and see what can you find from quality indicators that are embedded in the original client's data. A lot of the national offices have concepts of a must select on internal assessments, and many times those get missed until very late in the engagement timeline, because it's something that happens rare and infrequently. That's why it has to go through that national office consult. So if the frontline teams don't know about that required consult, it's usually caught like sometimes on a concurring partner review even. And then the national office is stuck between a rock and a hard place on timelines. And I'm actually a believer that when an issue is found in a project management perspective, can be a quality indicator. If you find it very last minute in the engagement, it can actually get treated differently than finding it earlier in the engagement. And I'm not just talking about treating it from the sense of, did you do the right procedures from audit? I'm actually talking about the commercial considerations on people are usually not having the conversations on out of scope. Do we even want to continue this engagement because this issue is so large, and yada, yada, yada. And when I say out of scope, everybody knows that I'm implying to the out of scope overage fees associated with something that is out of scope from the original intent of the engagement. And so when you find those early on in the engagement, you get to have the right conversation with the customer and the client versus finding it at the very last minute and everything is all hands on deck to do the right audit procedures good enough, well enough to the standards to be able to issue that opinion and not have the risk of not making a deadline, because we're all very deadline oriented. So finding those concepts of those high risks across your entire portfolio of engagements, I think is going to be the future of where some of this audit innovation is going to come in. Now, getting into, and I'll see if there's any more questions. No. Okay. Getting into some big ticket transformational processes. To me, risk assessment is the big one. We came out with a SAS 145 guide, I believe it was like the week before Edge or right at the Edge. And what we're recommending is people start to figure out what is their approach for SAS 145 pretty soon, like if not like now, to have some real tests. The guide does go through for any of my international team members. We did also put the ISA 315 revised 2019 sites into the document, and as well as the PCAOB AS standards. So even though we called it the SAS 145 guide, it is cross-referenced to those other two standards. And one of the other reminders is even the PCAOB is putting out their reminders, because this was, I think, just like 3 months ago that they put this out. Yeah, June. That they put it out, like, don't forget, risk assessment is going to be a key focus of our approach. We have provided outreach to many of the regulators on the approaches that are now capable through technology, and making sure that the regulators are aware of what can be done through technology in the innovation space there. So the approaches aren't getting to be too scary for a lot of the regulators. Clearly, the devil's always in the details. And so I'm not going to go too deep into the guide, but I did want to talk about what's covered in the guide, and then let everybody go read the guide when you disagree with me and argue with me because you think it's too big. So if you go back to my original conversation on what is anomalous, right here, I believe that let's pretend that this is showing something that's relevant to a control environment. I think the control environment on the left, where I have tightly clustered concepts with not a lot of noise, is a different control environment than the thing on the right. That means when you look at how different every transaction is from each other, you have a component of control risk because you can see how things are bypassing controls, and you have a component of inherent risk. And the reason you have a component of inherent risk is because it's explicitly stated in the standard, SAS 145 paragraph A11, I believe it's either A8 or A9 in ISA 315, that talks about the volume or lack of uniformity in the composition is an inherent risk factor. I also believe that the risk assessment process was not meant to be a theoretical only assessment, that the actuality of the data that you're auditing is relevant to your assessment of risk of that particular audit that you're supposed to respond to. So it's not a theoretical only exercise. And then again, the control environment shapes how a transaction comes to be in that ledger, not a test of controls, just a shaping. The control environment shapes the structure of that transaction. And so because of that, in our SAS 145 guide, we go through 3 approaches to risk assessment. The first is that you could actually make the argument that MindBridge is the risk of material misstatement because it includes inherent risk and control risk. Now, I will be quite honest, and I am the co-author of this document. I think that's a little too aggressive. I don't believe most firms will find that to be appropriate. I would personally find that to be a little bit too aggressive in most cases. Now, there may be some cases that for particular assertions, I'm okay with that. But honestly, I believe there still needs to be a concept of theoretical judgment because not everything presents itself in a data set. So let's pretend like a valuation assertion on a mark-to-market security. If they're doing one-off, once-a-month journal entries, the selection of did they pick the right valuation like rate is not going to ever be in that particular data set. So in that case, you probably do want to balance it out with a theoretical assessment. However, I'm going to argue with myself on that one and say, look, it's rare and infrequent. It only happened 12 times a year. It's already going to get a pretty high score that actually covers that risk because it's sitting at high risk. And maybe at that point, I don't even want to deal with that assertion through some kind of modified approach. So I think that's a little too far extreme for almost everybody. What I think is a very comfortable place, still very much leaning forward, but a more comfortable leaning forward is that you can use anomaly detection as a numeric input into a risk assessment theory that includes traditional risk assessment selection criteria. So you pick out your theoretical inherent risk assessment, your theoretical control risk assessment, and then you balance that out with the actuality of the data that you're seeing at that interim stage. And then roll forward. By the way, one key note, when you do roll forward, always check the report that talks about what changed from interim, if they had any post-closing entries back into interim periods to make sure you didn't miss anything big. And then let's say that's still too forward, too aggressive, too complicated. We do talk about the approach where the MindBridge score is it happens to be quantitative in its nature, but you use it as a qualitative input into your selection criteria for inherent risk or control risk. That one would probably be more so inherent risk that most people would pick out. So it can help you pick out which risk factor or which risk thresholds you'd like to use. So I'll let you go back and watch the webinar, download the SAS 145 paper on there rather than use my last 7 minutes getting into the weeds and talk a little bit about processes. So again, I wanted to talk about this because the control components of transactions. And most of the time, most LCE engagements, less complex entities, don't have tested controls done on them in any meaningful way. And it's not because that the controls don't exist. Now, that may be the case. So there's a bucket of LCEs that do not have controls that exist. I hear you loud and clear. But there is a bucket of LCEs that do have strict controls. Mainly, many times, it's the owner manager that signs off on all checks and there's no cash disbursement without his or her approval. And there's actually a very robust control environment, but there's nothing to document. How do you test it when there's nothing to document? So as you start to think about, you can see some processes by the transaction structure, how they get shaped together. You can start to see how you can fit in and redesign some of those LCE engagements to start potentially maybe taking on some tested controls in a limited way because you have the ability to test them. So one of the approaches is, let's talk about like an old system-based control, like a traditional system-based control. Most people assess the design of that control, and then we'll do a sample of one to make sure that that control is operating as designed, right? If we can start to segment the entire population, I'm going to go back to one of my favorite slides. back here, if we can identify the populations that follow the control in a very meaningful way, can we not validate with a sample of a couple? So I'm not saying just one, I'm just saying a couple, whatever that means. Can we not validate that that control works as designed in that sample? We already have the subpopulation that we know followed that sample. And is that good enough? And for the things that don't fit into that control, okay, then we have to decide, okay, what do we do with those bypassing controls? So maybe it's not the right approach for that, image on the right where you have the noise everywhere and there's lots of potential for bypassing controls. But if we have an entity that actually has a control environment, we just can't test it because there's nothing observable. Can we start to rethink our traditional tested controls into something that looks more like the system-based control testing procedure? So I'm not saying it's a system-based control. I'm saying use the concepts we've already been using for system controls by able to see what the control populations are of what we know to have followed the control as the end result, because we have the answer key, because we have all the transactions, versus what we know to have not followed the process and the controls. So a lot of that is our roadmap, and a lot of that is what Joe will be talking about. And we've also built out several tools in order to do it. So you can actually start to isolate processes based on the accounts that they hit, as well as we've created some custom ensembles so that you can actually create specific bundles of ensembles yourself to the extent you want to very specifically test something. We actually have some people automating certain procedures that they already have in existing workflows and requirements through creating a custom bundle to test something very specific in that regard. And I would be remiss if I didn't end on the reliability and I'm going to check for other questions while we do this, on the reliability of relying upon a technological output, especially with the new ISBA Technology Ethics Project. So one of the things that you need to be assessing on all your technologies, technically this applies for Excel too. So, I mean, maybe most people will be like equals 2 + 2. Okay, that resulted 4. I feel good about that today. But you do have to make these assessments going forward. Most firms are already doing something related to the reliability, but we're putting it very forward to making sure all of our customers know about it so they don't get dinged in those peer reviews or inspections. And if anybody's going to argue with me on the confirmations.com from the PCAOB spotlight that came out earlier this year, Q1, maybe early Q2, when I read that one, to me, that is a reminder to assess your technology and never blindly rely upon technology. I do not think that was intended to be do not use technology. I think that was a warning shot across the bow to make sure you're assessing your technology across the board to make sure you are able to rely upon your different technologies. So the big important one for us and that you should have for any of your organization or other software outputs that you use, we have your kind of standard list, but the algorithm assessment where we had all of the algorithms validated to make sure that they're low risk for bias and they're working as designed. Just so you know, this company, University College of London, that did ours, after they did ours, they realized that this is going to be a very lucrative service line for them because we were the first ones to go and have created a spin-off called Holistic. I think it's called Holistic AI. So next year's report will actually be named something different, but it's the same underlying company. That was it. So I think I have 2 minutes left. I do have to end right on time because I'm supposed to launch the Ask Mindbridge Anything sessions right after this. So I hope you'll be able to join us from there. So any questions you don't get answered right away from me, you can also ask me there or ask Michael B., who is the co-author on our SAS 145 guide. And I can't say it enough that I really suggest you look at Joe Welsh's session from this exact time slot, as well as our November webinar on what we're doing on identifying processes and different disaggregations on revenue analytics, like disaggregated revenue analytic concepts and process identification. So with that, any other questions? With the 1 minute left? Y'all are the quietest group of all time. Okay. Well, thank you so much for your time today. I hope you've enjoyed the conference, and I will see you at Ask Mindbridge Anything.